What is up, investors? Jason here. So there's a lot of drama going on over in the stock market and the crypto market, and things are getting a bit out of control. They've been out of control for a while, but we were seeing some hope a little bit with the crypto market showing a good rebound, which I'd say it still is, of course, but we have been seeing some pullback in the markets in general, and a lot of what's going on at this moment is, of course, the inflation that is just absolutely insane, and it's much more than what was previously expected. And you know that we're going to be getting into rate hikes and different things to really slow down the rate of inflation, because just free money had been, just thrown out there for a while now, or low interest rates that businesses had been able to really expand the size of their companies, like Apple, Amazon, Tesla, for example. Many companies had really expanded the size of their companies from 2019 on into basically recently, where they're now talking about raising interest rates, which we had to expect was going to happen at some point. And of course, this is going to affect a lot of things, including the housing market and such. Maybe not as much in certain areas where there is a big shortage on housing, but in other areas where there is not a big shortage on housing, that's going to probably start affecting the housing prices there. So a lot of things are going to really be happening with raising rates to curb down the rate of inflation. And this is definitely something right now with what the Feds are talking about is messing with the markets at this moment. So in this video, we're going to be talking about what's currently going on, talking about rate hikes, talking about inflation. So as we get to it, if you guys don't mind, please do me a huge favor. Please be sure to smash the story annihilate, or just gently press that like button to help me out with the YouTube algorithm and spread the videos to more people that might find it interesting. And subscribe if you have not already, and listen to me on other platforms like Spotify. If you just like the audio only formats, I'm there as well. So now let's get to it. So the St. Louis Fed chair is looking for supersized rate hikes, and this is a bit extreme in my opinion. So the Federal Reserve Bank of St. Louis President James Bullard said that he supports raising interest rates by a full percentage point by the start of July, including the first half-point hike since 2000. Yikes. In response to the hottest inflation in 4 decades. He said, "I'd like to see 100 basis points in the bag by July 1st. Bullard, a voter on monetary policy this year, said in an interview with Bloomberg News on Thursday, "I was already more hawkish, but I have pulled up dramatically what I think the committee should do," he said. So basically, he's talking about raising interest rates by 0.5% in March and another 0.5% by July. And that's a pretty extreme interest rate hike. And yields on 2-year treasuries, which had risen after the CPI print, climbed further after Bullard's comments to reach about 1.58%, the highest since January 2020. While 10-year yields rose about 2.04%, the highest since August of 2019, Fed swaps now show a full point of tightening over the next 3 meetings. Now, in January, the Consumer Price Index report showed a 7.5% annual increase in inflation. That is insane. This is the largest amount of inflation that we've seen since 1982. So this is a 40-year high for inflation. There definitely are reasons to be concerned about what's currently going on. So now what I want to do is I want to talk about the VTI, Vanguard Total Index. It's this ETF here that is a little bit of the entire stock market. And what I want to do is I want to talk about the performance of VTI over the period of time from the beginning of January 2021 to now here in February 2022, because it's very interesting when you think about what's been going on with the stock market and where things have really progressed over this period of time. Now, looking at the beginning of 2021, where we had seen the price of VTI at $193 or so on that particular day. And then we look at where VTI was at the beginning of 2022, where we're seeing the price of VTI actually hit its all-time high of $244 at that time, which, if you think about it, that's a very large amount of growth. I mean, we're talking about the price of that going up more than 25% or so from then in that period. So that's a very unnatural amount of growth that you usually wouldn't see within the stock market. And this is literally a ETF of the entire stock market. So in reality, that's pretty insane to think about. Now, when we look at where we're currently at a price of $227 at this time. So what we're seeing is we're still seeing the price of it around like up about 17% or so, more than 15% for sure. And this is still a really large increase in the price. Now, of course, we saw this dip here. We saw a dip where we had seen it dip in the third week of January, and then we just quickly started seeing it correct after a couple of days. We just call it a correction. That's what everybody calls it. But I mean, it definitely is a market sell-off. It went to an all-time high. That we went up a lot. It became some fear in the market. A lot of people sold. Then there's what happened with Meta, with FB, and what we had seen was a large amount of the market cap of Meta, leave, and a lot of people sold out of that, and then they reinvested into other things, and that's just been the way that money's been kind of moving here. And in reality, still the stock market going up, 15% or so in a year is also not really a natural number. 25% is not common. 15% is not common. 8% makes sense. 9% will make sense. Even 10% would make sense, depending on how the years progress. Some years, you might see the stock market not actually go up. Some years you might see it go up a few percent. Anything can really happen there, but you don't usually see for 2 years in a row the stock market going up so much from 2020 into 2022. You don't usually see it go up as much as it did. That's very unnatural in reality. So I just wanted to kind of just point that out. Now with the interest rate hikes, now that's definitely going to slow down a lot of this growth that we've been having. We will be seeing the stock market possibly not grow definitely the way that it has, because these companies aren't going to have the money to keep pumping into their companies. I mean, you think about the amount that Apple has grown in a short amount of time from 2018 on into now. I mean, the company has, more than doubled in size of market cap in that period of time. And it's been a company since, the 70s. So a lot of things have happened in the stock market that was very unnatural. A lot of it was caused with companies having access to money without having to pay off debt. It was cheaper just to keep getting the money because the debt was so cheap in interest. Just pay the lowest amount. Don't focus on paying off this large amount of debt. Now these companies are not going to have access to this money, but at the same time, a lot of them do have a lot of cash on hand, and they can continue growing from there as well. So that's going to be another interesting thing there as well. But other areas, we will definitely see a bit of trouble, like for the housing market, for example. The housing market had gone up a lot because interest rates were low. A lot of people were, borrowing money and such. But now when we see the interest rates go up, what's going to happen is we're going to see the prices of houses in a lot of areas start going down. It's all going to depend a lot as well on supply and demand, of course. There's plenty of areas that have very low supply, and you might not see that much of a change there, depending on the amount of money that a lot of people have in those areas. But in other areas, they're definitely going to be affected a lot by this, and some people won't have access to borrow against that, to borrow against their house, because their house value will probably go down. So we're going to see things change a bit. We're going to see the reaction of what's going on have different effects in different ways. We might see different areas react differently to interest rates going up. And it definitely is going to more than likely slow down the stock market. It's definitely going to change the housing market. And it could, but it could make a lot of people more money in other ways, like people that are going to put money in bonds, or put money in the bank. You might get a little bit more money in different ways. So some people are going to play it very smart, and some people not. And it's just going to be how things are going to be from here on. But I know I'm rambling on a bit about that. But anyways, I just wanted to make this video to kind of just talk a bit about that topic. I'd like to hear what everybody's thoughts are on inflation, on interest rates hikes. Let me know. So with that being said, please like, share, comment, subscribe. New podcasts coming out all the time. Thank you for watching.